Welcome to Global Insights with me, Punita Kumar Sinha. Today we will discuss the world outside equities, that is commodities, currencies and the fixed income markets. Joining me today are Peter Fisher, Senior MD and Head Fixed Income Group at BlackRock, and Rick Deverell, Head of Commodity Research at Credit Suisse. Let's first take a look at how these markets have performed in the recent past. Nikhil Shivadas has this report.
It's been a year of extremes for the world economy. The crisis in Europe and the slowdown in America had a cascading impact on all asset classes, from equities, bonds and currencies to commodities. Commodity prices soared on the back of quantitative easing and higher oil prices driven by supply concerns from Iran and the Middle East. Brent crude, which is currently at around $118 per barrel, is up more than 30% since June, when it touched its 18-month low of $88.49 a barrel. High food and fuel prices, lower interest rates and monetary easing by central banks in turn have led to a flight of capital to safer havens like gold and silver, which has been the outperformer in the precious metals market.
You're going to see more money printing, more debasement of currency, and therefore the price of gold will go much higher over the course of the decade. I would prefer to buy silver. Silver is 40% off its all-time high.
Rising commodity prices lead to rise in the current account deficit of import-dependent economies and result weaker currencies. Take for instance the case of the rupee. China, on the other hand, has seen its currency fall on account of a slump in international trade. At the other end of this spectrum are high-yield currencies like the Australian dollar, the Singapore dollar and the euro. The big factor driving currencies these past few years is the loss of faith in fiat money on account of high sovereign risk. A case in point is the US dollar.
The growth differential is going to support the dollar, so we're looking to be buyers of dollars into weakness. And we're also sellers of risk into strength, the corollary of the US move.
From currencies to bonds, by May this year, the sovereign creditworthiness of several economies like Greece, Portugal, Italy and Spain came under a cloud. The cost of borrowing for the governments of these economies rose. Capital took flight in safe havens like the 10-year German, Japanese and US bonds, which saw yields come down to 1.5, 0.8 and 1.6% respectively. However, the sovereign risk for the US and Japan was on a rise because of falling perceived creditworthiness, which in turn led to a downward revision in their sovereign ratings and sent sovereign credit default spreads higher.
There will be a search for yield. Indeed, hurdle rates, these are sort of risk-free rates, and now established quite firmly in terms of the Fed framework of rates on hold, at least now until mid-2015. And I also believe the action by the Fed, even if it's mortgage-backed securities, is also providing a form of cap in terms of bond yields. And that provides a good foundation for searching for yield. So whether there's a toss-up between equities, credit or high yield, I do think they will provide a continued run over the next coming months.
The focus is now clearly on the world's largest economy, the US, where the Fed recently announced open-ended bond purchases to support the economy. But the big worry is whether the US will jump the fiscal cliff in early 2013 when several tax breaks expire and spending cuts come into place.
Now let's talk about commodity markets where India's impact is increasing. Rapid economic growth, rising consumption, growing manufacturing sector are all accompanied by increased demand for commodities in India. India already comprises 30% of global demand for oil. While China is the key driver to commodity prices, India's role is increasing. What will that do to prices and returns for investors investing in commodity markets? Let's go across to Rick Deverell, Head of Commodities Research at Credit Suisse, and find out what investors should expect from commodities markets. Rick, thank you for joining us. Rick, let's focus our discussion on commodities where India is a big importer or exporter. We will first start with oil, since India is a big importer of oil. Given demand destruction globally and the geopolitical risks from the Middle East, where do you see oil prices longer term, and what alternative sources should India consider as the economy grows?
I think if you're looking at the next couple of years, I think that particularly given the constraints on supply and the challenges in the Middle East, the market is likely to remain relatively tight. So I would expect Brent oil to remain a little bit above $100 for the next year or two. But I think if you move further out, if you move sort of 2015 and certainly by 2020, what is striking about the price of oil at the moment is that in real terms we've never seen prices at this level for any sustained time. So the current price of Brent oil is about 250% above the long-term average. And that suggests to me as a macroeconomist that the price will come down. It's very difficult to identify exactly what will drive that, but high prices ultimately always kill high prices. And already you're seeing a whole bunch of innovations in terms of the demand side. There are very big substitutions occurring. And on the supply side, I think the kind of thing that's going on with shale gas in the United States at the moment is really interesting in terms of illustrating the kind of technological change that can occur over time. And I think that ultimately that will actually start bringing the price of oil down. So in the short term, I think it's going to remain very tight. But as you move 5 or 10 years out, I think that it will actually come down a lot more than a lot of people think possible at the moment.
So you think shale gas discoveries will help the pricing of oil and gas? Is that something India should be counting on, and will India benefit from that trend?
Look, I think it will. I mean, there are two elements to that question again, I think. In terms of India specifically, the really big challenge India has at the moment is that India is not really passing through the real price of oil to consumers. So one of the big challenges, as I understand it, for India is that there are big subsidies still in terms of petroleum products, and that's having a really big impact on the budget. And perversely, that's one of the reasons that demand destruction is not occurring as quickly in India as it is in other areas, and that's just because people aren't seeing the real price of oil. But in terms of the global price of oil, I think shale is a real game changer. I think that what's been interesting over the past couple of years is that this technological revolution has brought down the price of natural gas in the United States. That has already flowed through to the thermal coal market because the US has become a big exporter of thermal coal as power stations are substituted to natural gas rather than thermal coal. And my understanding is that whilst it will take some time, there's a lot of natural gas in China in particular. And I think that will, as we move forward 5 or 10 years, become a big part of the global energy mix. And that's part of the reason that I think oil prices will ultimately come down.
Rick, let's shift now to precious metals, particularly gold and silver. As you know, India is again a big importer of gold, and gold prices have risen in India as the rupee has weakened. Central banks have also been buying gold, and that has increased sharply. So what kind of fundamentals do you think are going to drive gold prices from here, and what upside do you see?
I don't think the gold is actually a physical market at the moment. I think the main driver for gold at the moment is financial demand. And that is that a lot of people are very concerned about the global financial system. A lot of people are very concerned about fiat currencies. And that means that they're looking for a safe haven, and gold has traditionally played that part. So in the very near term, I think that there is a lot still to be worried about in terms of the global financial system, particularly some of the issues that still face Europe. And that will persist for a time, and that probably means that gold will move a little bit higher over the next 12 months. But at some point, people will still start feeling better about the global financial system, as they always do, as the crisis sort of comes to an end. And in that world, my suspicion is that gold will fall very heavily. So at the moment, again, gold prices are very, very substantially above the long-run average. And my guess is that if you're looking 5 and certainly 10 years out, they will move back towards that average. So whereas at the moment we've got gold prices sort of $1,750, my guess is that in 10 years' time it'll be more like $800.
Rick, now moving on to coal, where India also has a huge demand due to its power needs. And of course, countries like Africa also need to develop power and need coal. So where do you see coal prices headed? Because that will affect electricity prices in India.
In the very near term, I think that thermal coal prices will be reasonably stable. What has been really remarkable over the past year has been the impact of the revolution in natural gas in the United States on the coal market. And what that has meant is that the United States, for the first time in a long time, has become a major exporter of thermal coal. And whilst demand from India and China is still very strong, that has been offset by the increase in supply from the United States and a few other countries. And I think that will persist for some time. So my guess is that prices will be reasonably stable for the next year or so.
Rick, agricultural commodities have been on a sharp rise this year. Do you believe that global warming and changing weather patterns, as well as rising demand from India and China, will cause these prices to be much higher in the future?
The average price of the grains, that is soybeans, wheat and corn, actually fell by 85% in real terms between 1950 and 2002. Since then, of course, there's a couple of things that have happened that have meant that that downward trend looks like it's come to an end, and it does actually look like these prices are starting to move up again in trend terms at the moment. The two really big influences there have been, one has been emerging market demand, and as you say, particularly China's imports of soybeans have gone up enormously, and that has been a big a big impact in terms of the rate of growth of global soybean consumption. But the other one that is also very interesting is US ethanol, and more generally ethanol across the globe. In that, what I think a lot of people miss is that with the US corn crop, and US has traditionally been the big swing supplier to the global market for corn, more than 40% of US corn production this year will be used in ethanol. Or to put it another way, ethanol consumption in the US with corn is now bigger than the whole seaborne market. And they've been two really big structural things that have happened on the demand side that have seen the rate of growth for those two agricultural commodities pick up substantially.
Rick, now one of the few commodities that India is a big exporter of is iron ore. With demand slowing from China, do you see any pickup in the iron ore prices, and can India benefit longer term due to its iron ore reserves?
In terms of the near-term price, what has been very interesting is that after sort of sitting at about $150 for a time, iron ore prices have come crashing down in the past couple of months and fell to about $85 about 2 weeks ago. But since then they've rebounded quite strongly, and today are sitting at about $110. And my guess is that that's probably a fair price for the time being. But as we move forward, iron ore is very different than a lot of other commodities in that there is no physical shortage of iron ore. In fact, a very large proportion of the Earth's crust is actually iron ore. So it's just a matter of time before supply catches up with demand and the price comes back down. So if you're looking at a longer run price, again, if you look at the past 100 years, the average has been about $80 in real terms. And my guess is that where it will settle. India has been a very big exporter of iron ore. And if you'd had this conversation 3 years ago, most analysts would have confidently predicted that India's exports of iron ore would increase from, at that time, about 80 million tonnes a year, probably up to 120 or 130 million tonnes a year to China by now. But in the fact, what's actually happened is that Indian exports have collapsed. So rather than going to 120 million tonnes a year, they're running at about 40 million tonnes a year. And a lot of that has been because of domestic politics in India. And a lot of that's being driven by a newfound nationalism in Indian politics, and particularly the concern that India will need that iron ore in the future to develop its own steel industry. So it's kind of one of the wild cards in the iron ore market at the moment. If India was to go back to 120 million tonnes of exports, I think the iron ore price would fall very heavily. But at the moment it looks like they're going the other way, and some people are even speculating that India will become an importer of iron ore in the next couple of years as people move to try and keep the iron ore at home for the expansion of the domestic industry.
Now, India is also a big consumer of zinc, and Indian zinc demand is 10% of global demand growth. What is your view on metals like zinc and copper?
When I think about industrial metals, whilst there are some very interesting supply-side dynamics, in the short term, mainly metal prices will be driven by the pace of global growth. So in really simple terms, if we can get a global recovery going next year, I think those prices will go up. Whereas if we continue to splutter along with growth below average, they probably move sideways and go down from where they are now. So it is very growth dependent. But in terms of the specifics of those two metals, again, I think they actually have quite different dynamics. Copper at the moment is the metal that is most tight. It's the one where the price is significantly above long-run averages. And that's mainly because people have been really struggled to get copper out of the ground, and global copper supply actually fell last year. But it does look like over the next 2 or 3 years, copper supply should expand substantially. So my guess is that in 2 or 3 years' time, copper will probably be a little bit cheaper than it is now. Zinc, on the other hand, is one where there has been very abundant supply over the past couple of years, but some of the really big zinc mines are going to basically run out of zinc over the next couple of years. So I suspect that there's a possibility that you have a little bit of a pinch in terms of zinc supply, and zinc prices actually move up. So whereas at the moment everyone favours copper, I think if you move 2 or 3 years out, it's possible that zinc becomes a more attractive investment prospect.
So Rick, what would you advise the Indian retail investor who's investing in agri-commodities as a hedge against food inflation and also investing in gold as a safe haven?
With agriculture, I think agriculture is a very nice place to be at the moment, because I think that the underlying tendency is for prices to move up. But you do need to be able to withstand significant volatility, because we don't know exactly what's going to happen with the weather next, but we do know that whatever happens will move the price up or down substantially, given the low level of inventory. So I think it's a nice place to be for investors, but I think you need to be able to weather that kind of volatility. Again, I think that in the near term, gold is a very good investment, because I think that it is back on the longer run trend, and I think that a lot of people are still very worried about the financial system. But as we move towards a more stable financial environment, as global growth gets going, hopefully in the second half of next year, I would start thinking about an exit point for gold.
Rick, thank you very much for that. Let's now move on to the fixed income market and find out whether they can continue to offer the good returns that we've seen from them in the past. And how does India look to global fixed income investors? Joining me to discuss that is Peter Fisher, Senior Managing Director and Head of BlackRock's Fixed Income Group. Peter, let's start by looking at returns from fixed income. Fixed income has outperformed equities over the last few years. Is that trend likely to continue over the next several years?
No, I don't think so. I think fixed income has outperformed equities for two reasons. One, we've all been noticed the central bank policies have been very easy. The other that I think is less noticed is that in advanced countries, the supply of credit's been shrinking. We've had a credit crisis. So reduced supply, lower rates has led to an ongoing rally in fixed income. And a third reason I should quickly add is the central banks like the Fed have been expanding their balance sheets. The Fed has been buying assets, trying to drive rates lower, and that's shrinking even further the supply that's left for other investors. Now, those sets of circumstances are going to start to diminish. We hope to see credit pick up, the growth of credit, borrowing by corporations and individuals. It's very hard for the Fed to keep lowering rates, so that's a side of the rally that's not like to happen. The Fed is still expanding its balance sheet now, but that one I expect if the economy were to pick up, they'd stop that. So those special factors that have led to the really powerful rally in fixed income, I think, are over.
Peter, now we're in a low yield environment in the developed markets. So where are you looking for yields? Is there opportunity amongst the fixed income markets globally?
Clearly, the developing world, India, Brazil, China, broadly speaking, the developing world will continue to provide higher returns for investors, both in the equity and fixed income markets going forward for the next 5 years. The growth rates will, on average, be more rapid than they are in the developed world. And so that's an important source of return for investors in the developed world to try to capture. Now, clearly, different countries have different challenges in the short run. There's no guarantee that this is a good time to be buying investment securities, bonds in any particular country. But over the 5-year horizon, still there's a big appetite for emerging market countries.
Peter, you've talked about opportunities in the developing world. It appears that in the developed world, corporate credit is better than consumer credit, and the consumer is still hurting. Whereas in the emerging world, consumer balance sheets are in better shape than the corporate sector. But now, of course, the slowdown has also started hurting the emerging world. We are seeing increased downgrades of the corporate sector in India. Are you worried about the risk of downgrades for emerging markets like India and for their corporate sector?
Well, yes, I think we've seen the rating agencies have on their forecast horizon whether they may be negative watch on India. I think the Indian fiscal position, given the slowdown in growth and the large budget deficit, is a source of worry about backup in India, particularly given the capital controls that are still in place, and it's hard for international capital to come in and out of the country very smoothly or quickly. So I think that is a concern. Different corporates, as I say, some developing economy corporates already have global franchises, and their revenue base is diversified beyond their home. Others are much more narrow national plays, and their business model is more tied to the country, and thus the slowdown in growth in the short run over the next year, I think we still face a risk of a slowdown in the major emerging markets growth, particularly Brazil, India, and China. We see the slowdown. I expect we'll find a floor on that slowdown sometime in the next 6 to 9 months, and that would be a positive development.
Do you have any recommendations for what should be done about deepening the Indian fixed income market?
Well, it is, you'd certainly have to open up, make it easier for corporations to borrow and encourage the development of a corporate borrowing sector. And you'd have to loosen some of the requirements for the banking sector to be invested in government bonds, a little less financial repression, we would say, a little less limitation on choice. And I think, though, the capital account, opening up the capital account to permit foreign capital to come in, those three, I think, will be the most important steps to take.
And Peter, finally, what is your view on EM currencies? What's the trend?
I think that, again, the higher growth rates over the 5 to 10-year horizon will tend to strengthen their currencies. But I think we have a lot of uncertainty today. I look at the United States, where, given our natural gas developments, the United States could become energy independent in the next decade. We've talked about that for 30 years, and we've never achieved it. But it looks as if some of the developments in our natural gas area could lead us there and maybe even make us an energy exporting country. That would hugely change the expectation for the dollar. One reason the dollar is always under a downward pressure is because we're an energy importing country. So that's a big issue. I think the question of opening the capital account in both India and China, which I would hope would happen over the next decade, that would lead to much more flexibility in both those exchange rates. That might go down, it might go up. I think we get a lot more currency volatility. But I think in general, developing economies will have a higher growth rate once we get past this soft patch, this slowdown in growth. So I'd be thinking of the next year or two as the chance to buy emerging market exposure and take the currency risk and expect them to rally more over the coming decade.
Peter, thank you very much for that. So there is a lot of opportunity for investors in India, both to invest in commodities and fixed income markets. Now let's go across to Tanveer Gill, who has some important data points about these markets. Tanveer, what does the data show?
Well, I just compared all the asset classes across the board, on their year-to-date 3-year and 5-year returns, Punita, and it just seems that commodities really are the ones which stand out. I mean, gold has been a standard performer on a year-to-date basis. You've seen the 3-year and 5-year returns, especially the 5-year returns for gold have been almost to the tune of about 150%. Oil, on the other hand, given its importance for India, I mean, we've seen that one as well. Over a 3-year period, give a return of about 15%. There's a 5-year return coming in of 30%. U.S. Treasuries, on the other hand, and when we're comparing fixed income returns to equities, have been steady given the risk return profile, but the returns have been anywhere between 2.5% to 5% at best. Again, year-to-date 3-year and 5-year period. The Nifty, however, and the S&P 500, which are the key indices on the equity side, have outperformed the fixed income side of the market, but not so much the commodities. So there could be a bit of a play there. And Punita, that brings me to my question for you. Purely from an India perspective, how do you see, what kind of fundamentals do you see driving commodity prices?
Well, Tanveer, I think India should be very interested in what happens in commodity prices. Let's look at the trade deficit. Gold and oil are actually comprising almost half of all of India's imports. In fact, oil is about 1/3 of India's imports, and gold is about another 15% or so. So this is a big concern for India's economy, because India's trade deficit could very well rise if the commodity prices don't come down and India doesn't find alternative sources for commodities. Now, the second reason that India should be obviously interested in what happens in commodity markets is because the company's profitability does get impacted as these commodity prices go up. So these companies either need to hedge for these input prices, or again find alternative cheap ways of finding and sourcing these commodities. And the third and the most interesting one is that actually investors in India are very actively trading commodities. Historically, India has been one of the largest markets for commodity trading, and in fact, if you look at MCX, it's already become the 3rd largest exchange in the world, single largest exchange for trading of commodities.
All right, talking about fixed income and currencies, how do you see the opportunity there evolving?
Of the total mutual fund assets, fixed income is only about 25% of the total mutual fund assets. As a comparison, in the US, the market is much more developed. Fixed income is almost equal to that of equities at 50% of the total mutual fund assets. And of course, a large part of that is still US Treasuries, but the corporate bond market is quite large at about 20% or so. And that needs to develop in India as well. And I think it will over time. And of course, currently foreign investors can't invest too much in the fixed income markets. But again, as we see, interest rates in India are still very high. So there are opportunities for foreign investors to come in and capture some of these yields. And as inflation comes down and interest rates come down, we might actually see, again, a long period of potentially better returns. Well, that's my view. With that, it's a wrap on this edition of Global Insights.